We're going to walk through short exercise 5-14 now. This is a conceptual exercise for the most part. This is good material for getting multiple choices questions from, etc. So this is good. And I'm going to circle the question so you try to answer it, put me on pause, and then see what the answer is. The first one, true or false? Credit sales increase receivables. Collections and write-offs decrease receivables. True or false? That is absolutely true. Credit sales will increase receivables, collections and write-offs decrease receivables. The next item down, number 2, true or false? A proper way to express credit terms is FOB shipping point. Is that true or false? That is false. Credit terms are things like 210 net 30, FOB shipping point. That is the shipping terms. That is not a credit term. That doesn't deal with when you need to pay the invoice. Number 3, which receivables figure, the total amount that customers owe the company, or the net amount that the company expects to collect, is more interesting to investors as they consider buying the company's stock? Give your reason. So, is it the total amount or the net amount? The net amount is the more interesting figure because that is how much the company actually expects to collect. The total amount is everything. So as an investor, I would be more concerned with the net amount, how much they really will collect. The fourth one down, show how to determine net sales revenue. Net sales revenue will be sales revenue, less sales returns and allowances, less sales discounts gives you net sales revenue. Number 5, show how to determine net accounts receivable. Net accounts receivable is accounts receivable minus its contra asset minus allowance for uncollectibles and gives you net account. That's accounts receivable net. Number 6, the direct write-off method of accounting for uncollectible understates assets. Is that true or false? That is false. The direct write-off method overstates assets because it fails to show the amount of the receivables the company actually expects to collect. Number 7, Carolina Bank lent $150,000 to Sumter Company on a 6% six-month note. Which party has interest receivable? Which party has interest payable, interest expense, interest revenue? How much interest will those organizations record 1 month after Sumter Company signs the note? This has a lot going on in it. Carolina Bank has interest receivable and interest revenue. Sumter Company has interest payable and interest expense. The interest for 1 month for either party is the $150,000 note principal times the 6% rate times 1 month divided by 12 months, or $750. So that's how you would answer number 7. Number 8, when Carolina Bank accrues interest on the Sumter Company note, show the directional effects on the bank's assets, liabilities, and equity. Increase, decrease, or no effect. What we're going to see here, Carolina Bank, accrual of interest, assets will go up and equity will go up because they have an interest receivable, which is an asset, and they have interest revenue, which is equity. Both those would increase. For Sumter Company, who's borrowing the money, when they accrue interest, they will accrue interest payable, which is a liability going up, and they will accrue interest expense, which reduces equity. So that's what's going on in number 8. Number 9, true or false, credit card sales increase accounts receivable. That is false, actually. Credit card sales are usually recorded as a cash sale with a credit card discount expense. So a credit card is very similar to cash for a company because they get the cash pretty much immediately. And finally, number 10, true or false, companies with strong liquidity usually factor receivables. Factoring receivables deals with selling them to other companies to get the cash before they actually collect the customer's cash. That would be false. Factoring receivables can be very expensive. Companies that have strong liquidity, meaning they have lots of cash, usually choose a less expensive form of financing. So that's it for this exercise.